Why don't we start off with the Middle East? Obviously, very topical. Things have changed a lot in the last 3 months when the war started. We're right now under somewhat of a fragile ceasefire, let's call it.
hmm
Obviously, oil prices have come down substantially, which is a good thing. But what are your thoughts going forward, Bob?
Well, I think it's still a time of uncertainty. It seems to me that there's been many announcements of a ceasefire, a end of warfare, and yet the next day there's further activity in that front. So I think you have to assume that that's probably going to continue for some time at least. What's fascinating about it is that you've had this global superpower, the U.S., unleash a tremendous amount of weaponry on Iran, and hard to know what's actually happening in Iran, but certainly it would seem that they've been a very resilient foe to the U.S. through this whole period, and the ability of them to create risk around the Strait of Hormuz is a interesting risk that I don't think was necessarily fully appreciated going into this. And it seems now that the Iranians are planning to assert more control over that strait and perhaps apply tariffs or fees to transport through that part of the waterway. And so that's would be a terrible outcome, I think, overall. It's going to have a real impact on trade through the Middle East, and the movement of oil in particular is a big part of that. But there's so many other commodities that flow through that strait that are really concerning. So interesting to see how that's playing out. I think there's another aspect to all this that's really quite interesting to follow, which is the change in technology in warfare, that you can have effectively cheap drones playing a much bigger role in both this war with Iran, but also, of course, what continues in Ukraine and Russia as far as just the use of technology and cheaper technologies as a very effective weapon.
Yeah, I think the leverage that Iran maybe didn't even know they had before the war started is certainly a card that they're playing hard right now. And it would set a dangerous precedent if you start tolling on international waterways. Obviously the Strait of Hormuz is one of the most important in the world, but there are other potential choke points all over the world that could be very disruptive. Um, Certainly a little bit surprised that oil prices have actually come down below where they were
Right.
before the war started.
Yes.
There's been a tremendous amount of damage to Middle Eastern energy infrastructure. I think even if you're a ship owner, once you get your ships that have been trapped in the strait for many months, once they're out, how quickly are you going to be to put them back in
Yes.
harm's way?
Yes.
What are the insurance companies going to do? Obviously, they're going to increase their premiums massively, I would think. And we still don't really know what the end of the game is here.
Mhm.
Obviously, there's been a lot of um, bullets come out on their framework, but as you said earlier, we've been back and forth on some issues, and whether the U.S. eventually comes out with anything more than they had before this all started. And as you point out, unfortunately, Iran's probably figured out that they have this card that they might be able to play anytime that they want to sort of hold the world hostage, so to speak.
Yeah, it's
Um,
unfortunate for sure.
w-
Oil's interesting though too, as you say. Like
yeah,
uh, you know, it's very difficult to move or to restart oil movements and natural gas movements with all the infrastructure issues, to reposition ships globally to where they may need to be for both the pickup and delivery of these fuels. So to have oil bounce back so quickly, now of course the markets are always forward looking, so that's I guess what's happening right now, or it appears to be what's happening right now. But it does appear that it's happening too quickly, and that's certainly, I think our thesis has been that it would take some months, quarters perhaps, before you'd get back to some sort of normalization. So I wouldn't be surprised to see some shock in the system here. at some point that maybe drives oil prices somewhat higher again for at least a period of time, just because of this, just the logistics of the movement of these commodities.
Yeah, it's hard to know where oil is eventually going to settle down, so to
Hmm.
speak. Global inventory levels are at historical very low levels. Many governments around the world have been using their strategic reserves, and eventually they're going to have to replenish those, which obviously creates demand for oil.
Hmm.
And it's interesting. I think a lot of countries are going to be second guessing where their oil comes from, and
Yes.
I mean, the Middle East has always been sort of a potential source of uncertainty, and is it reliable? Is it safe? I think Canada actually is in pretty good position right now because obviously we're considered a very stable nation. I think it times very nicely with some of the things that Prime Minister Carney is trying to do to increase the exports out to the West Coast that they can then take to Asia to get a premium on natural gas, like LNG, that sort of thing. So very interesting times.
Yeah, I think you're right. Unfortunately, the challenge for Canada is that a lot of these initiatives take many, many years to put into place to get more oil and gas to the coast. You've seen some positive movement in that direction, but these things take years to actually implement. I think certainly the pipeline expansions to the west, to BC, have helped us in that sense. And to your point, you see a lot of European buyers of our oil, and I think over the long term it will benefit Canada in the sense of just being a stable market to draw from for at least some portion of energy requirements around the globe. It's just, again, it's going to take time, and so do we kind of revert back to this, period where if things sort of calm down in the Middle East, do buyers just kind of revert back to their old sources of oil and gas?
Yeah.
What's also interesting though is that China has historically been that marginal buyer of oil, and for some reason they haven't really come back into the market to date. So that's also a factor I think that's playing out right now.
Yeah. Yeah, so I guess the summary of what's going on in the Middle East, I mean, we're going to probably find out more sometime in this 60-day negotiation period. For the markets, I would say it really comes down to the terms on the Strait of Hormuz and how quickly does traffic sort of return to normal levels, where does oil finally reset, and that's probably going to be the key driver for the months ahead for the market.
Yeah, I think so. I think the other factor that's playing out here is just the politics of the U.S. and the midterm elections coming up is another factor, right? That I think is a pressure on the current administration, because higher oil prices mean higher gas prices, which in the U.S., which is a real negative for the U.S. midterm, or for the Republicans in this case. So it'll be interesting to see how that whole negotiation plays out. As you say, is how does the Trump administration navigate that environment where they're trying to get to a peace, trying to perhaps lessen the risks of Iran around nuclear capabilities, but not have this kind of drag on indefinitely, and the Strait of Hormuz being held hostage.
Yeah, it's been obviously a very unpopular war in the States, very costly. Doesn't do anything for the cost of living, which has been a key issue for Americans for the last couple of years. And President Trump talked about the risk of a global recession if they didn't try and de-escalate and come out with a solution. But I think obviously the key for him is the U.S. and the downward pressure in his approval ratings that certainly aren't helping the Republicans' cause to hold the Senate and the House.
No question.
But one of the challenges that the U.S. has in particular is that core inflation, which backs out energy and food, has also been rising. And that sort of has flipped the script, so to speak, in terms of future policy actions by the Fed. What are your thoughts on where rates may go, and what are some of the factors that they're thinking about right now, Bob?
Yeah, I think it's put Warsh Fed in a difficult position, right? It's that inflation has remained sticky. As you say, it's ticked up with these higher oil prices. So some of that hopefully comes off here in the near term, if oil prices stay lower for longer. And the current data would suggest that may be the case, but certainly inflation has remained sticky and well above the 2% target that is the Fed's stated policy target. So I think the Fed's got in a position where they have to watch this very closely. I think they don't want to leave things untouched too long. I think ideally they have to be seen to be acting prudently. But I think it's a real challenge for them that they have a president who is very, very vocal about not raising interest rates, but actually lowering interest rates. But I just don't see that as being possible this year to see further rate cuts. And as you know, that's been our view for some time now, a period of higher for longer, and that may be just because of inflation rates remaining higher.
Yeah, it's interesting. I mean, when Kevin Warsh, the new chairman of the Federal Reserve, just got appointed a couple months ago, the expectation was that he was going to be pushing for lower interest rates, and I think he really shocked, certainly the media and a lot of people at his first press conference, and he came out very adamant that he was going to bring inflation back down to their 2% target. He talked a lot about returning price stability to the American economy. And all that means typically is higher interest rates.
Mhm.
And as you said, I mean, that's exact opposite of what certainly President Trump wants. And hard to know what's best for the U.S. economy right now. We're seeing a little bit of softness in job creation more recently. Obviously, that factors in AI that's potentially displacing some jobs, that sort of thing. But they are sort of caught between a rock and a hard place to some degree. So,
No question.
and then you've just to add sort of more uncertainty to the equation, Kevin Warsh has brought some new thinking to the Fed, and he's actually appointed 5 new task forces to look at various aspects of how the Fed makes policy decisions. And clearly he wants to shake things up. He thinks that they could do a better job of what they've been doing in recent years, but all that's going to bring some question marks for the markets going forward.
Well, I think it does in any case, right? I mean, there's been long periods with the Fed where there was, I'll say, a lack of transparency around their thinking, and then through the great financial crisis, they tried to bring more transparency through things like the dot plot, and his view is that that's something that they don't want to continue to do or provide the same level of transparency moving forward. I think markets adapt to these things, right? I think moving back to something that's maybe not as transparent, if you will, is manageable, and I don't think the market's really fussed by it too much. I think he said the right things, frankly, that he's not going to just simply do as the president asks, because that would be way more damaging to markets and interest rates for sure if he was seen to be doing that. And
Right.
but there's no question he's going to have pressure from the administration. It's interesting that that rhetoric has not picked up as yet. It would seem. Certainly, when Powell was in the chair, it was seemed unrelenting. And so maybe there's a honeymoon period that he's operating within at the moment that maybe is giving him a bit of time. But I think it's there's certainly questions around, are interest rates going to rise this year? You've seen the EU really moving in a direction of higher rates, at least with one increase. But I find it hard to imagine that the U.S. will move to higher rates this year. But again, this is all data dependent, so we'll see as the year progresses.
Yeah, I think certainly they have some breathing room with oil prices having declined as much as they had.
Right.
Maybe they may peak up a little bit again, but they probably have got a number of months, perhaps, into the midterm elections before they have to make an unpopular policy decision potentially.
Well, yeah, and I think to your point though too that the Fed typically tries to stay out of the fray, the politics around election time frames. So I have to imagine as the midterms approach, they'll be doing their best to sit on their hands and get through that before they make any sort of actions.
Yeah, I guess that sort of flows through to what the Bank of Canada may or may not do. Um, Canada's facing a very different situation than the U.S. The positive side in Canada is that core inflation's actually right in target range.
Mhm.
So the Bank of Canada has probably successfully brought inflation down to a manageable level. Part of that is likely our economy has not been as strong as the U.S. We did hit a technical recession.
Right.
Not that that's an overly big deal. It just really means we're in a period of fairly sluggish growth. But the one wild card now is really the Canada-U.S.-Mexico trade agreement. We just found out literally last week that the U.S. decided not to renew. So they've sort of put it up for review. Probably not a big surprise given a lot of the commentary that was coming out of Washington, but it does sort of create this uncertainty for businesses in particular going forward. What is the new world going to look like?
Yeah, I think it isn't surprising that the U.S. has used this as a negotiating tactic in effect. I mean, really, it's status quo is effectively the position you're in, that the existing agreement continues. But it will probably give them opportunities to go after certain pain points, perhaps. Maybe it's Ontario's lack of U.S. alcohol on our shelves is a point that they want to take issue with us on, or agriculture, milk, and all these sorts of things. They could potentially sort of try to get some concessions around without going through a full blown change in the agreement. But I think it just creates, though, a level of uncertainty for trading across the borders, Canada, U.S., Mexico, for sure. You just have this increase in uncertainty, and from a Canadian perspective, the negative to that is really about more long-term decision making that businesses have to try to make, as far as deploying of capital. Large capex type spends often get delayed because you just have greater uncertainty, and when Canada's so reliant upon the trade with the U.S., having that increased uncertainty with this annual review process that we'll now fall into, it's definitely a negative. And I think back to the Bank of Canada, they're in a position now where, as you say, interest or inflation is relatively low. So their mandate is met. They may have to stimulate, frankly, if things got much worse. But largely on hold position, I think, is really the case, right? So what it does mean, though, is again, because of higher inflation, and what that does for the bond market is you're seeing more volatility at the longer end of the bond market, and the shorter end is probably going to be more stable as a result.
Yeah, and we've actually seen a little bit of stimulus to the Canadian economy indirectly with weakness in our Canadian dollar. So Canadian dollar's dropped, a few cents over the last number of months, and that's good for our exports. So we've still got roughly 90% of our exports to the States that are tariff-free, and they are benefiting from having sort of that strong U.S. dollar coming in. So that probably acts as somewhat of a rate cut indirectly.
Right, a stimulant.
So we had tremendous uncertainty in the Middle East. We just talked about some upward pressure on bond yields because investors suddenly flipped from expecting rate cuts to worried about rate hikes.
Mm-hmm.
But lo and behold, the U.S. stock market had one of the best second quarters in history.
Yes.
What do you think's driving that?
Well, it's certainly a market that's being driven by a subset of I'll say the index. If you take the S&P as an example of the market, right? It's still being driven, but very much around the whole AI theme and that story and how that's playing out. What's been interesting, of course, as the quarter progressed, is you did see a bit of a rotation. You've seen a rotation, into semis and out of semis. You've seen a rotation out of the big mega cap tech names to some degree into other parts of the market, more recently into financials and healthcare a little bit. But so it's an interesting environment, but yeah, it's been a market that's been driven again largely by this whole AI theme. And I think what's been interesting is in that sense is that over time, the story started off, it was about, the Nvidias of the world, and that was how you played AI. And I think now what you're seeing is really a look beyond the label kind of approach, which is saying, well, it's not just about the chips. It is about the infrastructure around those platforms. It's about cooling capabilities and power. Power, I think, is central to this whole story that's been playing out, and certainly it's been part of our approach to investing around AI is looking at the infrastructure side of the markets, and seeing where there's opportunities there where you could invest and I'll say play this theme, but at better valuations, right? I think that's been a great aspect of the team's approach to this and a benefit. But you're right, very resilient markets. The wars seem to be largely discounted. Again, rising inflation has to date been largely discounted. Although I think if we did see the long end of the bond market spike up closer to say 5%, that tends to be more of a tipping point where equities tend to start to really suffer.
Certainly a risk that we're monitoring. The one thing that surprised me, and we've known obviously for a while that there's literally hundreds of billions of dollars being invested in data center build-outs, AI infrastructure for multiple years. But I've still been surprised at how dramatic the impact on earnings growth has been. So if you look at expectations sort of for the next couple quarters in the US, we're looking at sort of 20%-ish earnings growth, which is an exceptional level considering we're really in quite a sluggish economy.
I mean, just the quantum of spend that's occurring in the technology sector currently around AI, and the capex is being deployed there is without precedent, right? If you look across that full spectrum of sectors of the market, you would see, of course, as you say, like you're not seeing the same level of growth in other parts of the market as you're seeing in AI, but that in itself is skewing the overall earnings growth of the S&P 500 as a whole. What do you think that's 40% of the S&P, which in itself creates its own risks as an investor. When you think about it, often we would think about the Canadian market, the TSX, as being a very concentrated market and having those risks because of that. The US and the S&P 500 for a time was this more diversified way of investing in a broad pool of companies. But today, you are investing 40% of your dollars if you're buying the S&P 500, say in an ETF, you're buying technology, and that's been a great place to be. But I do think, and our philosophy has always been, and you need to be more broadly diversified than that. You want exposure to these opportunities, particularly when they are so transformative like AI, but you want then to broaden that or complement that by being in other parts of the market, other sectors, and certainly other geographies.
Really what we try and sit back on is look at across a diversified value chain, which are the quality companies that we think are going to be able to sort of be there throughout this entire journey that we're going to be on for the next few years, rather than try to play the week-to-week volatility. That's somewhat of a mug's game, I would say.
No question. You just can't win at that approach.
Obviously, a lot of these technology stocks are already anticipating many years of very strong growth, and that's probably gonna transpire. What you don't know is, will that pace of growth maybe slow a little bit? And there are some potential obstacles. I mean, power limitations could be one of them. Are there enough memory chips that can be produced to sort of drive agentic AI, which is sort of the next phase of the AI cycle? And the risk for investors, if you make a a wholesale bet on technology and all of a sudden growth rates slow relative to expectations, those stocks can come down very quickly.
You know, a name like Alphabet, extremely profitable, growing at a good pace, having significant exposure to AI through their LLMs and some of their other investments. So you know, these are the things where, again, I think you have to step back and look beyond the headlines of chasing a SpaceX, which, you know, is doing some incredible things for sure, right? Musk and his people are just pushing the boundaries on so many fronts, which is probably good for the most part. But to chase something like a SpaceX just doesn't fit well with the discipline that we want to bring to how we construct our portfolios.
Yeah, I think it's probably a good, at least at this point in time, it's a good highlight of what's probably a good company, but may not be a good stock to invest in. We obviously always are trying to find high quality companies, but we also want to be careful about how much we're paying for earnings today and potentially earnings into the future.
No question. And as you said before, what we're seeing is on the slightest of negative news, these high flyers get whacked really hard. And if your goal is to protect capital and for your clients, then those are difficult names to be investing in. If a stock can fall 15%, 10-15% in a day, that's probably a risk you don't want to be taking, certainly in any great degree.
Yeah, and there's, probably as always, there are a lot of risks, a lot of minefields out there that could come our way. Things could keep going up, but we feel pretty well positioned. With the diversification across sectors, we've got companies that are publicly traded. We have companies that are privately traded, including infrastructure. Our private equity fund, which we launched, about a year and a half ago. It's been really a real positive surprise for us because we certainly didn't expect to see the type of returns that we've seen this early in the cycle. We've done a really good job of sort of getting through that initial phase where there's a lot of costs and fees, but we've seen some good payoff from some of the early investments in that strategy.